Most traders don't lose money because they lack indicators. They don't lose money because they don't understand charts. They lose money because they don't understand themselves. If you trade options or futures, you already know how fast things can go wrong. One bad decision turns into another. A small loss turns into a big one. And suddenly, you're not trading the market anymore. The market is trading you. Before we go any further, there's something important you need to understand about trading psychology. Most traders think psychology means staying calm. That's not what it actually means. Trading psychology is not about controlling emotions. It's about designing a system that doesn't require emotional control in the first place. If your strategy relies on you being calm, disciplined, or focused at all times, it's already broken. Because under real market pressure, with real money on the line, emotions will always appear. The goal is not to eliminate emotion. The goal is to prevent emotion from influencing decisions. And that's the difference between traders who survive and traders who repeatedly reset accounts. This video is about the psychology behind those mistakes, not strategies, not indicators, not signals. We're going to talk about why your brain sabotages your trades, how emotions override logic, and how to build mental rules that protect your capital, even when the market is moving fast. If you can master this, you won't just reduce losses. You'll finally give yourself a chance to be consistently profitable. One of the biggest myths in trading is that smarter people perform better. In reality, intelligence can make trading harder. Smart traders tend to overanalyze, override rules, trust their judgment too much, rationalize bad trades. Trading punishes confidence without discipline. The market doesn't care how right you feel. It only responds to risk, probability, and behavior. The most dangerous phrase in trading psychology is, "I know this will bounce." That sentence has destroyed more accounts than bad strategies ever could. Your brain was not designed for trading. It was designed for survival, pattern recognition, avoiding pain, chasing reward. Markets exploit all four. When price moves against you, your brain interprets it as a threat. Options and futures are not psychologically neutral instruments. They magnify everything. Profits feel bigger. Losses feel heavier. Time pressure feels intense. Unlike stocks, leverage means the market doesn't need to move much to affect your emotions. A small candle against your position can trigger anxiety. A quick spike in your favor can trigger overconfidence. This creates a dangerous cycle. Fast wins convince you that you're skilled. Fast losses convince you that you need to act immediately. And the faster the market moves, the less time your brain has to think logically. This is why traders who do well on paper or in simulation often struggle when real money is involved. The pressure changes everything. Your heart rate increases, your breathing changes, your focus narrows. This is not a mindset problem, it's a biological response. In that state, you hesitate to cut losses, you move stops, you revenge trade, you double down. You are no longer making decisions, you are reacting. The key to preventing future losses is removing decision-making during emotional states. Loss aversion means losses feel more painful than gains feel rewarding. A 500 loss hurts more than a 500 gain feels good. Because of this, traders cut winners too early. Traders hold losers too long. Traders refuse to accept being wrong. In options and futures, this behavior is amplified by leverage. The market doesn't need to move much to trigger panic. The solution is not to be okay with losses. The solution is to predefine loss as part of the system. A loss is not a failure. A loss is a business expense. The moment you personalize losses, your edge disappears. Another psychological factor most traders underestimate is decision fatigue. Every chart you watch, every candle you analyze, every maybe setup you consider drains mental energy. By the time a real opportunity appears, your judgment is already compromised. This is why traders who stare at charts all day often make worse decisions than traders who step away. The brain needs recovery time. When it doesn't get it, impulse takes over. You start taking trades that don't meet your rules. Not because they're good, but because you're tired of waiting. Overtrading feels productive. You feel engaged. You feel involved. You feel like you're doing something. But overtrading is usually driven by boredom, fear of missing out, needing to make money back. The market does not pay you for activity. It pays you for selectivity. Professional traders often wait hours for minutes of execution. If you feel compelled to trade, that's a warning sign, not a signal. Revenge trading is not about money. It's about ego. You're not trying to make money back. You're trying to prove something to the market, to yourself, to your last trade. The moment a trade becomes personal, logic is gone. Revenge trading usually includes increasing size, lower quality setups, ignoring rules, emotional entries. The only cure is time separation. Loss, step away, reset, no exceptions. Many traders believe if I watch the chart closely, I can control the outcome. You can't. Watching price tick by tick increases anxiety and impulsive decisions. The more control you try to exert, the less objective you become. Your edge should exist before the trade begins. Once you're in, your job is execution, not prediction. Many traders believe their biggest weakness is discipline. So they try to be stronger. But willpower is unreliable under stress. It weakens with fatigue. It weakens with losses. It weakens with pressure. This is why professional traders don't rely on discipline. They rely on constraints. Constraints remove choice. And when choice is removed, emotion has nothing to attach itself to. The best traders don't rely on willpower. They rely on rules. Examples: max loss per day, max number of trades, fixed position sizing, mandatory breaks after losses. Rules remove emotion from the equation. If you only follow one principle, let it be this: you cannot trust yourself under pressure, so plan for it. Confidence comes from outcomes. Discipline comes from process. Markets reward discipline, not confidence. True confidence is knowing you followed your rules, you controlled risk, you survived to trade tomorrow. Your goal is not to win today. Your goal is to stay in the game long enough for probability to work. Most traders fail because they compress time. They want profits now, recovery now, validation now. Trading is not a sprint. It's not even a marathon. It's a career-long probability game. The moment you stop rushing results, your decision quality improves. One of the most dangerous psychological traps in trading is being almost right. The market comes close to your level. Price hesitates. Your thesis feels validated, but not confirmed. So instead of exiting, you wait. You tell yourself, it just needs a little more time. This is where small losses quietly become large ones. Not because the trade was bad, but because you became emotionally attached to the idea. The market does not reward almost right. It only rewards execution at predefined levels. The moment you start hoping instead of executing, you're no longer trading probabilities. At some point, every trader has to make an identity shift. You stop thinking like someone trying to make money. If you want to prevent future losses in options and futures, remember this: you don't need a new indicator, a new strategy, a new system. You need fewer trades, smaller size, stronger rules, emotional awareness. The market is not your enemy. Your reactions are. Master those, and the money follows. If this video helped you understand trading psychology on a deeper level, take a moment to reflect before your next trade. The most powerful edge you can build is not on your chart. It's in your mind. Trade smart, protect capital, and remember, survival comes before profits. Before your next trade, remember this: the market will always offer opportunities, but it only rewards traders who are emotionally prepared to wait for them. You don't need to trade more. You need to trade better and less often. Protect your capital, protect your mindset, and give yourself the time needed to become consistent.